I'm about to show you something that's going to make you mad at your bank. See, right now, you're probably paying around $2,186 a month on your mortgage. That's the national average. But here's what they don't tell you. Over 30 years, you'll pay $624,441 for a $300,000 house. That means $324,441 goes straight to interest, more than the house actually costs. But what if I told you there's a way to cut that down to just 10 years and save over $225,000? And it's not refinancing. Let's dive in. Ever wonder why your mortgage payment feels like throwing money into a black hole? Let me show you exactly where that money goes and why banks designed it this way. See, let's go ahead and break down this typical $300,000 mortgage at 6% interest with that $1,799 a month minimum monthly payment. Here's what happens in your first year. Look at what happens in the first month. Out of that $1,799, $1,450 goes towards interest, $349 goes towards paying down what you actually owe on the house, all right? That's over 80% of your payment disappearing into the bank's pocket. Does that make sense? Only to the bank, right? You're basically renting money from the bank and they're charging you $1,450 a month for that privilege. Now, watch this. That's not all. By year 5, you've paid $107,940. But you still owe $277,982 on your house. How is that? You've only knocked off $22,000 from what you borrowed. The bank collected $85,490 in interest while you barely made a dent on your actual debt. Ladies and gentlemen, this is how amortization works. It's not designed for you. It's designed for them. So let me go ahead and show you the full picture. That $300,000 house that cost you the $624,441 over the 30 years, you're paying $324,441 in interest alone, more than that house originally cost. Now, I want you to think about that for a second. Would you buy a $30,000 car if the dealer said you'd pay $65,000 in total? What about a $500 phone for $1,000? Of course not. But that's exactly what happens with your mortgage. And here's what makes things even worse. In the early years, when you have the least equity and the biggest balance, that's when they charge you the most. It's completely backwards from how it should work. The system keeps you trapped, making mostly interest payments for the first 10 to 15 years. They probably showed you something like this, right? And that's why we stress another way. Now, this particular person has an income of $6,000 at $4,800 expenses, all right? So what does that mean? We're only gonna write what matters, and that's the cash flow, okay? A lot of people are like, yeah, but I don't have, I don't make 6,000, I don't make 12,000, I don't make 13,000. It doesn't matter. You know what does matter? This number right here. This is Mr. Cash Flow, and this is what's gonna pay off this, all right? Now, this is why we stress cash flow, because when you have the velocity banking tool called a line of credit, you can do so many things with it. This particular person has a line of credit of $20,000. And I know what you're thinking. You're thinking, yeah, but CJ, I don't. But you tell me what you're going to do with what you have. That's what life is all about. It's not about what you got. It's about what you're going to do with what you got. All right. So don't let the numbers distract you. Let them educate you. All right. This particular person may have 20,000. You may have 5,000. Do you know where it's going? All right. It's going to go towards the principal. Why? Because we've got to go ahead and lay the axe to the root. All right. So immediately, boom, the 6% no longer eats off of the 300,000. It's going to be eating off of the 280,000. All right. And that 280,000 that interest is going where? It's going to go down. So the traditional payment method would have had you decreasing by $1, right? And increasing or decreasing the interest by $1, increasing the principal by $1. But when you're doing this, we're talking about 40, 50, 60, sometimes hundreds of dollars because of what you're doing with this line of credit. Now, you may be asking yourself, but CJ, didn't I just add on another debt? Write this down. And if you could, write it down in the comments, right? And we have a book that explains all about this. Go ahead and just click on the description below if you need it right now. But lines of credit are not bills. Lines of credit, when used correctly, are leverage. All right. So do you remember the $1,200 that we have here? What we're going to do is we're going to transform, right, our line of credit into our new checking account. So that means that $1,200 that stays in our checking account is going to stay in our new checking account called the line of credit. So let's go ahead and draw this. And of course, you don't have to do the math. I've already done it for you. 16.6 months it's going to take us to replenish this line of credit back to $20,000. Can you tell me what happens after we have replenished this line of credit? We're going to deploy it again. Because what is it all about? It's not about having lines of credit and doing nothing with them. It's about making sure that this number right here comes to us instead of them. Because them getting interest and us paying for $349, right? And only having it decrease month after month by $1 is ridiculous. Now, don't get me wrong. Because the mortgage does score pretty high on the cash flow indicator, this should not be a priority for you, okay? This should be a priority for you at all. As a matter of fact, go ahead and comment below if you think the mortgage is a priority. I'm telling you, no, it's not, okay? You don't have to pay it off in the 10 years. But for those of you who want to, so that you can use your house as a bank. Maybe you have a HELOC. Maybe you need a First-Lien HELOC, okay? We can connect you with that as well, right? Just submitting that for your consideration. So here we have 16 months. After the 16 months, we're going to go ahead and slam it again and again and again. We're going to continue to rinse, wash, and repeat until after 10 years. Only 10 years. Excuse me. 10.66 repeating years. Okay, so let's just go ahead and round it up to 11. In 11 years, you are done with the mortgage. So no more mortgage. $17.99 actually goes into your cash flow now. So now you are cash flowing $29.99, almost $3,000. And with that $3,000, if you have a job that you have to earn income at, you don't have to have that job anymore, all right? In 2, maybe 3 years, right? You can go ahead and earn that passive income. You can be on passive income instead of earned income. And we actually have a connection with that now as well, all right? Folks, I want you to know that if you have a line of credit, then you have your debt weapon. Lines of credit are not debt. They're not debt, as you've seen, okay? Now, there are costs to borrowing money, but there's also costs of not handling your money correctly, right? As in the case of the traditional mortgage. That wasn't designed with you in mind. That was designed for the bank in mind. Now, you are the bank and you are in control. Do you see where the cash flow is? The cash flow is now in your system so that you can do with it what you want. Okay? So I just want you to know that in the beginning years, this is their plan for about maybe 10 to 15 years to make sure you pay as much as you can And during those years, if you notice, you'll get a what? A phone call, maybe a text. Hey, have you thought about refinancing? You know what that's code for? Hey, have you thought about starting over? Okay, you may save $100, right? Maybe even $200, but it's all about starting the clock back over so they get that interest. Do you know how much interest you'll save? So you've not only saved time, you've not only saved 20 years, you've saved over $225,000 in interest. And I don't know about you, but I think I do. I think time is the most valuable quality. What would you be able to do with $225,000? What would you be able to do? Maybe go see some game, maybe get another house, maybe a real estate property for your loved ones so that they can have rentals. Maybe you want to teach them about passive income so they don't have to earn and be on the cotton fields. I don't know. But I want you to copy this down and I want you to share this everywhere simply because I think the time has come. People are waking up to this death pledge. That's why I called it the death pledge, because that's what the mortgage is. That's literally the definition of it. And I believe it's Latin. Mort is death. And then gage is pledge, death pledge. That's what the mortgage is. Look at this. They took from you. They took from you. They took from you. But when you apply what you already have, and remember, don't pay attention to the number. Pay attention to the principle. You pay attention to the principle here, and you also pay attention to the principle here. The principle is using that line of credit for your advantage. All right? All right, so let's go ahead and see it, because I know the question is on your mind. CJ, what about the interest rate on the line of credit? Okay, let's say the interest rate is at 9%. All you got to do, okay, is divide the 9% by 12, right? And then multiply it by the 20,000, whatever the balance is, right? Whatever the balance is. And then that's how much interest you'll be paying per month. Then what you need to do is calculate, hey, is that worth it for me? And does it even come close to $225,000 in savings? Does it even come close to that? You know and I know that the answer is absolutely not. It doesn't come close to it at all. All right? Folks, I want you to go ahead and copy this down, please, 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 and memorize it. I'm talking about internalize it, because I want you to make sure you're using your lines of credit like they should be used. Use them in a way that's going to eliminate your debt very fast. And this is one of the ways you can do it. If you need help in getting a debt elimination roadmap put together, just let me know. God bless, and we'll see you in another video. If you are having trouble with this whole concept of velocity banking, I want you to check this video out right here, and we'll see you in another video.